Somewhere in the last 12 months, SoFi Technologies lost over 16% of its stock value. And yet, the same company grew its shares outstanding by more than 14%, brought in over $4 billion in revenue, and still turned a profit. So how does a company grow its business and lose value in the stock market at the same time? Stick around, because by the end of this video, you'll understand exactly what's happening beneath the surface of this stock, and there's one number coming up that might completely change how you see this company. Let's start with the basics. SoFi's most recent earnings report came out on Wednesday, July 29th, 2026, before the market opened. Keep that date in mind, because a lot of what we're about to cover flows directly from that report. Now, here's where it gets interesting. SoFi currently has 1.29 billion shares outstanding. That number has grown by 14.49% over the past year. In plain English, that means the company has been issuing a lot of new shares. And when a company issues more shares, each existing share represents a smaller slice of the pie. That's something long-term investors pay close attention to. On a shorter time frame, though, shares outstanding actually dropped by 1.89% over the last quarter, which is a bit of a reversal worth noticing. As for who owns this company, institutions hold 50.77% of it, while insiders, meaning executives and company leaders, hold just 1.49%. The float, or the number of shares actually available for public trading, stands at 1.27 billion. At first glance, SoFi's valuation looks expensive. The trailing price-to-earnings ratio, which compares the stock price to the company's actual past earnings, is 39.82. That's a high number, but here's the twist. The forward price-to-earnings ratio, which uses expected future earnings instead, drops to 25.60. That's a meaningful difference, and it suggests the market expects earnings to grow substantially. Supporting that idea is the PEG ratio, which compares valuation to growth, and it sits at 0.66. Generally speaking, a lower PEG ratio can indicate a stock's price is more justified when you factor in growth expectations. The price-to-sales ratio is 5.72, dropping to 4.49 on a forward basis, and the price-to-book ratio, which compares the stock price to the company's net asset value, is 2.20. But valuation ratios only tell part of the story. Let's talk about financial health. SoFi's current ratio is 1.11, meaning the company has just slightly more short-term assets than short-term liabilities. That's an important cushion. However, the quick ratio, which is a stricter test that removes less liquid assets, is only 0.46. That gap between the two ratios is worth remembering because it tells you a portion of SoFi's short-term assets aren't easily convertible to cash in a pinch. On the debt side, the debt-to-equity ratio is 0.31, which is relatively modest and suggests the company isn't overly reliant on borrowed money compared to its own equity. Now let's get into how efficiently this company is actually running. Return on equity, which measures how much profit is generated from shareholder money, is 7.09%. Return on assets is 1.25%, and return on invested capital is 4.68%. Here's where things get interesting again. SoFi's weighted average cost of capital, essentially the cost of the money it uses to grow, is 14.36%. Compare that to the 4.68% return on invested capital we just mentioned. That's a noticeably wide gap, and it's the kind of contrast that sharp investors tend to zoom in on. On a per-employee basis, SoFi generates $699,744 in revenue per employee and $104,306 in profit per employee across a workforce of 6,100 employees. In the past 12 months, the company paid out $101.48 million in income taxes at an effective tax rate of 13.76%. Let's shift to the stock price itself, because this is where the story gets a little more dramatic. SoFi has a beta of 2.20, which means its stock price historically swings more sharply than the overall market. Over the past 52 weeks, the stock price has fallen by 16.03%. Its 50-day moving average sits at $17.67, while its 200-day moving average is higher at $20.52. When a shorter-term average sits below a longer-term average like this, it's often a sign the stock has been in a downward drift recently. The Relative Strength Index, a tool that measures whether a stock might be overbought or oversold, currently reads 58.18, which sits in fairly neutral territory. Average trading volume over the past 20 days has been 61,798,631 shares, showing this is a stock with plenty of daily activity. And here's a number that might surprise you. Short interest, meaning the number of shares that traders have bet against, currently sits at 190.76 million shares, up from 185.96 million the previous month. That means 14.77% of all outstanding shares and 15% of the float are currently sold short. In other words, a notable chunk of the market is actively betting the stock will fall. The short ratio, which estimates how many days it would take short sellers to cover their positions based on average volume, is 2.22 days. That's a meaningful amount of skepticism baked into this stock, and it's the kind of detail casual investors often overlook. But let's not forget the actual business performance, because this is where SoFi starts to look different. Over the past 12 months, the company brought in $4.27 billion in revenue and produced $3.57 billion in gross profit. Operating income, which is profit after running the core business, came in at $737.74 million. And that figure also matches the pre-tax income. Net income, the actual bottom line profit, was $636.26 million, translating to earnings per share of 47 cents. On paper, that's a profitable, growing company. So here's where investors often get confused, because the balance sheet and cash flow numbers tell a very different kind of story. SoFi holds $3.37 billion in cash, against $3.42 billion in total debt, leaving a net cash position of negative $48.88 million, or about negative 4 cents per share. The company's equity, or book value, stands at $11.08 billion, which works out to $8.58 per share. Working capital, the cushion between short-term assets and short-term liabilities, is $4.93 billion. Now here's the number that changes the entire picture. Despite reporting positive net income, SoFi's operating cash flow over the past 12 months was negative $8.50 billion. After subtracting capital expenditures of $290.50 million, free cash flow comes out to negative $8.79 billion, or negative $6.81 per share. That is an enormous gap between the profit shown on the income statement and the actual cash flowing through the business. Depreciation and amortization added back $157.26 million, and net borrowing was negative $598.07 million. This contrast between positive earnings and deeply negative free cash flow is exactly the kind of detail that can get lost if you only look at the headline profit number. At first glance, the margins actually look impressive. Gross margin is 83.73%. Operating margin and pre-tax margin both sit at 17.28%, and profit margin comes in at 14.91%. Those are strong numbers on their own, but when you place them next to that negative free cash flow figure from a moment ago, you start to see why relying on just one part of the financial picture can be misleading. As for rewarding shareholders directly, SoFi does not pay any dividends at this time. Its buyback yield and shareholder yield are both negative 14.49%, which lines up with what we learned earlier about shares outstanding increasing rather than decreasing. The earnings yield sits at 2.61%, while the free cash flow yield is negative 36%, once again reflecting that same gap between accounting profit and actual cash generation. So what do the professionals think? The average analyst price target for SoFi is $19.98, which is 5.66% above the current price. 24 analysts currently cover this stock, and the consensus rating is a hold. Looking further out, analysts are forecasting revenue growth of 26.99% over the next 3 years, along with earnings per share growth of 42.57% over that same period. Those are ambitious numbers, and they hint at why the forward valuation ratios looked so much more reasonable than the trailing ones. As for fair value estimates like the Lynch fair value or the Graham number, that data isn't currently available for this stock. On financial health scoring, SoFi's Piotrowski F-score, a measure that checks a company's financial strength across several categories, comes in at 4, while the Altman Z-score, which is used to assess bankruptcy risk, is not available here. So let's bring it all together. On one side, SoFi shows real strengths: a profitable income statement, strong gross margins above 80%, manageable debt relative to equity, forward valuation ratios that look far more reasonable than the trailing ones, and analysts projecting strong revenue and earnings growth over the next 3 years. On the other side, there are real risks worth sitting with. A stock price down over 16% in the past year, nearly 15% of shares sold short, continuously increasing share count that dilutes existing owners, a quick ratio well below 1, and most strikingly, a free cash flow figure of negative $8.79 billion, sitting right next to a positive net income of $636 million. That single contradiction, a company that's profitable on paper but burning cash in practice, is the kind of detail that never makes it into a quick headline. So here's the real question we're thinking about. When a company shows strong accounting profits but deeply negative cash flow at the same time, which number tells you more about where this business is actually headed?